So hi, my name is Margaret Caraba. I am an entrepreneur and a Forex trader. So over the next couple of weeks, I am going to be teaching you guys how to trade. A side note is that this series is very beginner friendly. So we're starting from the very basic things to advanced level. So if you're new to Forex trading, then have no worries. We're starting from scratch. All right, let's get to it. In this lesson, we're going to cover the meaning of Forex trading, the history of Forex trading, pros and cons of Forex trading, and of course, we're going to conclude the lesson. So what is Forex trading? Forex trading is the buying and selling of different currencies on a global currency market. So essentially, it's just buying and selling different currencies. So this currency is traded through a broker or a dealer, but we're going to cover brokers and dealers in the third lesson. Major currencies that are traded are the dollar, the euro, the sterling pound, the yen, and the Swiss franc. So one thing you should know as a trader is that the Forex market is open for 24 hours a day for 5 days a week. So that's Monday through Friday. And this is when major financial centers are active. So the major financial centers are in Sydney, Tokyo, London, and New York. While not many traders focus on the history of Forex trading, I think that it's the basic knowledge that all Forex traders should have. So let's dive into it. So historically, our ancestors conducted trading of goods for other goods, and this was known as barter trading. However, barter trading became widely inefficient due to one, a lack of double coincidence of ones. So an example is if Trader Joe had a bag of rice and he wanted some bananas in exchange, but Trader Mary only had a bag of apples, then trading could not happen because Mary does not have what Joe wants. Do you understand? So yeah, there had to be a coincidence of wants. So the second problem was division issues, and this usually happened when one of the traders had huge items to trade with. An example is Trader Joe has his huge cow that he wants to trade for apples, bananas, and blueberries. Trader Mary only has one of those things. She has apples. And so what happened was that they couldn't trade because Trader Joe would not be able to just cut off a piece of his cow to get the apples. He wanted everything for his cow. So that made trading very difficult because dividing items like animals or big items for smaller items became very difficult. Third was a lack of common measure of value. So if Trader Joe had gold, let's say one bag of gold, and Trader Mary had one bag of rice, then it was difficult to trade because gold is inherently of more value than rice. But at the time, it was very difficult to measure like how much gold would be equal to a bag of rice. There was a lack of common measure of value. Eventually, forms of metal like bronze, silver, and gold came to be used to facilitate trade. And this was because it was easier to just give, let's say, some pieces of bronze or some pieces of silver in exchange for what you wanted. As time progressed, the obvious advantage of carrying around precious paper versus carrying around bags of precious metal was slowly recognized throughout the ages. So instead of carrying your precious gold to go trade with, you'd carry precious paper that represented the gold to trade with. So you'd carry your paper money and get your rice or your bananas in exchange for the money, the paper money that you had given. Eventually, stable governments adopted paper currency and backed the value of the paper with gold reserves. This came to be known as the gold standard. In July 1944, we had the Bretton Woods Accord, and this accord fixed the dollar to 35 USD per ounce of gold. So that meant that for every $35, you had 1 ounce of gold. And this is what we were talking about in the previous slides, a situation in which a country was backing the value of their paper money with the amount of gold reserves that they had. However, in 1971, President Nixon suspended convertibility to gold and let the USD float against other currencies. So he said, the dollar will not be equal to the amount of gold reserves that we have as a country because at the time, the reserves were depleted. We've talked about President Nixon letting the currency float. What does letting the currency float mean? It simply means that the government does not influence the value of the country's currency in relation to other currencies. In short, they let the market decide the value of the currency according to the supply and demand. And this led to the birth of retail trading. And retail trading essentially meant that people could buy different forms of currency or sell different forms of currency. Essentially, this opened up a marketplace for money exchange. With all this money exchange, the internet was a welcome addition to the trading environment, and here's why. So one, small upstarts actually found that this new technology, the internet, could improve trading, and it could improve the efficiency with which trading was happening. And two, it became increasingly evident that trading of money was exclusive to the governments, the banks, and the few elite who could afford to trade. And therefore, the internet was highly welcome because these upstarts created platforms for ordinary people like me and you to actually trade and make money. As is with everything in life, there are advantages and disadvantages. So here are the pros and cons of trading Forex. So Forex trading is the largest financial market which generates over trillions of dollars each and every year. It's for everybody. You don't have to be a bank or a really rich person to trade. You can simply get on the platform and trade. High volume and liquidity. Because of so many people trading all around the world, there's high demand and supply of different currencies that you might want to trade. Nobody owns the market, so it's very difficult to influence the supply and demand of different currencies. You can trade the highs and the lows. So the good thing about trading is that you can trade when a currency is doing really well, so that's when you buy it, and you can trade when a currency is doing really badly, so you can sell it. You can either trade during the highs, or you can trade during the lows and still make a profit. It's a 24-hour market, so you can trade whenever within Mondays to Fridays. So the disadvantages of trading, one is high risk. We call it high risk, high reward, in the sense that if you're not good at trading, you may lose a lot of money. You need to learn how to trade properly so you can minimize the risk of losing your money. Two, we have the suspension or restriction of trading. And this was seen especially during this time of the coronavirus, where stocks were plummeting, currencies were plummeting, and so there had to be a suspension or restriction of trading. So three, funds deposited with the broker may not be protected in the event of insolvency of the broker. So if broker A got shut down, and that's the broker I was using, I might not get my deposit back. So you have to be very careful with the brokers that you're choosing. Again, that's in lesson 3. We'll really talk about brokers. Trading facilities. So the broker's platform may malfunction and this can impact your trades. So you have to be very careful with your broker. Again, your broker can make or break your trades. And we are done with this lesson. I hope you enjoyed it. I hope you learned a thing or two. And if that was too much information, you can always find the slides on the link below. Don't forget to like, share, and subscribe. Thank you so much for joining me during this lesson. Bye!